This is a margin notice, published at 4:47 p.m. Eastern on January 29, 2026, by the CME Group, the parent company of COMEX, the world's largest gold futures exchange. The notice is 2 pages long. It uses technical language that most retail investors never read and wouldn't understand if they did. The notice announces an increase in initial margin requirements for gold futures contracts, effective February 3, 2026. The new initial margin? $11,500 per contract, up from $9,200. A 25% increase, implemented with 4 days' notice, the third margin hike in 6 weeks. The financial media headline writes itself. CME raises gold margins again. Crash signal? The narrative is familiar. Exchanges raise margins when they're worried about volatility. Higher margins force leveraged traders to sell. Forced selling crashes prices. Therefore, margin hike equals bearish signal. Gold crash incoming. This narrative is wrong. Not partially wrong, completely wrong. And understanding why it's wrong, understanding what margin hikes actually signal about market structure, reveals something that changes everything you think you know about where gold prices are heading. The truth is not that a crash is coming. The truth is that the institutions raising margins are terrified of what's coming, and they're using the one tool they have left to delay it. The margin hike isn't a warning that gold is about to fall. It's a confession that paper gold markets are about to fail. Here's what they're not telling you. Here's what they're not telling you. Margin requirements exist for a specific purpose, to ensure that traders can cover losses on their positions. When you buy a gold futures contract, you're controlling 100 ounces of gold, approximately $315,000 in notional value, with a fraction of that amount posted as collateral. At $9,200 margin, you're controlling $315,000 with $9,200. That's 34-to-1 leverage. If gold moves 3% against your position, approximately $9,450, your entire margin is wiped out, and you face a margin call demanding more capital. The exchange raises margins when they worry that price movements will exceed what posted collateral can cover. The official justification is always risk management and market stability. The notice published yesterday used exactly that language, to ensure continued market integrity during periods of elevated volatility. But examine what elevated volatility actually means in context. Gold has risen approximately 47% since January 2025. The move has been persistent, not chaotic. A grinding ascent rather than a speculative spike. Daily volatility metrics remain within historical norms. The VIX equivalent for gold, the GVZ index, shows nothing unusual. The margin hike isn't responding to volatility that exists. It's anticipating volatility that the exchange expects, volatility so severe that current margin levels might prove insufficient. What does CME see coming that justifies a 25% margin increase when measured volatility doesn't support it? The answer lies not in gold's price, but in gold's delivery mechanism. The February COMEX expiration, occurring this week, has 287,000 contracts standing for physical delivery against 11.2 million ounces of registered inventory. The ratio of delivery demand to available supply is the highest in COMEX history. If delivery fails visibly, if contracts standing for gold don't receive gold, the price response won't be a 3% move. It will be a gap higher so violent that $9,200 margin might not cover the losses for traders who are short. The margin hike protects the exchange from short sellers who might face unlimited losses. It does not protect long holders who benefit from rising prices. The asymmetry reveals whose positions the exchange is worried about. At 6:15 p.m. Eastern, 90 minutes after the margin notice, CME issued a supplementary notice that received far less attention. The supplement announced enhanced position limit monitoring for commercial participants with concentrated short exposure exceeding 5,000 contracts. Position limit monitoring for concentrated shorts. The exchange is watching traders who hold large short positions, because those are the positions at risk if gold surges. The combination of margin hikes and short position monitoring is the exchange telling you, without telling you, that they expect gold to rise violently, and they're worried about the shorts blowing up. If CME expected gold to crash, they wouldn't raise margins on both longs and shorts symmetrically. They would leave margins unchanged and let the crash solve their risk management problem. The margin hike is protection against upside, not downside. This is where the lie becomes unsustainable. The margin hike equals crash narrative assumes that raising margins creates selling pressure that drives prices lower. This assumption was valid in earlier market structures, when most gold futures traders were leveraged speculators who would sell rather than meet margin calls. but the composition of gold futures positions has changed dramatically. The traders standing for February delivery aren't leveraged speculators who panic at margin calls. They're institutions that want physical gold and view COMEX as a sourcing mechanism. When you raise margins on someone who needs physical metal, they don't sell. They pay the margin. They want the gold more than they want the cash. The margin hike doesn't create selling pressure from these participants. It merely increases the cost of maintaining positions they intend to hold regardless. The selling pressure from margin hikes comes from leveraged speculators, traders who control positions larger than their capital base can support when margins increase. These traders exist on both sides of the market. Some are leveraged long, some are leveraged short. The question is, which side has more leveraged speculation that will be forced to close? COMEX commitment of traders data answers definitively. As of the most recent report, managed money, hedge funds and speculative accounts holds 312,000 contracts net long. Commercial traders, primarily banks and dealers, hold 289,000 contracts net short. The commercial shorts are the concentrated positions that CME is monitoring. The commercial shorts are the positions that face unlimited loss if gold surges through delivery failure. The commercial shorts are what the margin hike is actually designed to address. When you raise margins by 25%, the leveraged longs must post additional capital or reduce positions. But the commercial shorts must also post additional capital, and their positions are larger, their leverage is higher, and their losses accelerate if gold rises rather than falls. The margin hike creates pressure on both sides, but the side with concentrated risk, the side the exchange is specifically monitoring, is the short side. The hike is designed to force shorts to reduce exposure before delivery stress produces uncontrolled losses. The paper versus physical distinction transforms the margin hike's meaning entirely. Paper gold traders, those using futures for price speculation without delivery intent, respond to margin hikes by adjusting positions. The higher cost of leverage pushes marginal traders out of the market, reducing paper trading volume. Physical gold traders, those standing for delivery because they want actual metal, don't respond to margin hikes at all. They're not speculating, they're acquiring. The margin is simply cost of access to the delivery mechanism. The margin hike widens the gap between paper and physical. It pushes paper traders toward the exits, while physical buyers maintain positions. The composition of remaining open interest shifts toward buyers who want metal, precisely the buyers who create delivery pressure that the shorts cannot meet. The historical evidence is unambiguous. Every major gold bull market has featured margin hikes that the financial media characterized as bearish. Every time, the hikes preceded further price increases rather than crashes. January 1980. COMEX raised margins repeatedly as gold approached $800. The narrative was identical. Regulators cracking down on speculation. Crash imminent. Gold reached $850 before finally correcting. August 2011. CME raised gold margins 5 times in 3 months as gold approached $1,900. Each hike produced headlines predicting collapse. Gold reached $1,921 before correcting, and the correction took 4 months to develop, not 4 days. March 2020. CME raised margins during the pandemic panic. Headlines screamed crash. Gold fell briefly, then rallied 40% over the next 18 months. The pattern is consistent. Margin hikes during bull markets are rearguard actions by exchanges worried about short positions, not prescient warnings of price declines. The exchanges aren't predicting crashes, they're managing the risk of squeezes. The January 29th hike fits this pattern exactly. Gold has risen 47% in 12 months. Shorts are under pressure. Delivery demand exceeds available supply. The exchange raises margins to force position reduction before delivery stress produces catastrophic short losses. The crash incoming narrative isn't analysis. It's the narrative that short interests want you to believe, because if you believe it, you might sell, reducing the buying pressure that's destroying their positions. When institutions do what they're doing now, they're not managing markets, they're managing their own survival. At 8:45 a.m. Eastern on January 30th, the morning after the margin notice, JP Morgan filed an 8K supplement disclosing material changes to precious metals derivative exposure. The filing revealed that JP Morgan reduced gross gold derivative positions by $14.2 billion in the final 2 weeks of January. The reduction was concentrated in short-dated contracts, positions expiring February through April. $14.2 billion in exposure reduction from the largest precious metals dealer in the world in 2 weeks, following a margin hike that supposedly signals gold is about to crash. If JP Morgan believed gold was crashing, they would maintain or increase short exposure, profiting from the decline their analysts presumably forecast. Instead, they're reducing exposure at the fastest pace since 2020. The behavior contradicts the narrative. The bank isn't positioning for a crash. The bank is fleeing from short exposure before something much worse than a crash, a delivery failure that produces unlimited losses on positions they cannot cover. HSBC filed similar disclosure at 10:30 a.m., Citibank at 11:15 a.m., Bank of America at noon. The four largest bullion banks in America filed simultaneous disclosures showing combined gold derivative reduction of $27.8 billion in 2 weeks. The margin hike didn't cause this reduction. The reduction was already underway when the hike was announced. The hike formalized what the banks were already doing, exiting short positions before the delivery stress that's visible in open interest data produces the squeeze that's visible in their risk models. The mainstream narrative says margin hike means crash. The institutional behavior says margin hike means the banks are terrified and running for the exits. Believe the behavior, not the narrative. Less than 72 hours remain before the margin hike takes effect on February 3rd. Between now and then, every trader must decide: post additional margin to maintain positions or close positions to avoid the margin call. The decision for leveraged longs is straightforward. If you believe gold is going higher, you post margin and hold. If you're uncertain, you reduce position size to a level your capital supports at higher margin. The decision for leveraged shorts is existential. If gold surges through delivery failure, your losses are theoretically unlimited. Posting more margin to maintain shorts increases exposure to an outcome that could be catastrophic. The rational response is to cover, to close shorts and eliminate the risk. The countdown to February 3rd is a countdown to forced decision. Every trader with insufficient capital to meet the new margin must act. The actions create price pressure, but the direction of that pressure depends on who has more positions they can't support. The data says shorts are more vulnerable. The data says commercial short concentration exceeds long concentration. The data says the banks are already fleeing. The margin hike accelerates what's already happening. The physical gold market is telling you the same story through different data. Since January 15th, physical gold premiums over paper prices have widened from 18% to 31%. The widening accelerated after the margin hike announcement, not because physical gold became scarcer, it was already scarce, but because paper gold became less credible. Each margin hike reinforces the message. Paper gold requires institutional support to function. Higher margins mean higher costs. Higher costs mean more friction. More friction means paper gold becomes less attractive relative to physical gold. The premium is the market's judgment on which gold is real. The premium widening after the margin hike means the market judges paper gold as less real, not more safe. While Western exchanges raise margins, Eastern exchanges offer different terms. The Shanghai Gold Exchange, the world's largest physical gold market, has not raised margins in 2026. The Shanghai Futures Exchange maintains gold margins at levels 40% below COMEX equivalents. The differential creates arbitrage incentive. Traders who want gold exposure can access it more cheaply in Shanghai than in New York. Capital that might have flowed to COMEX flows to SGE instead. The Western exchanges' attempt to reduce risk drives business to Eastern exchanges. The geographic shift that has characterized gold markets for years accelerates with each Western margin hike. The metal moves east, the paper stays west. The divergence widens. China's policy response to Western margin increases has been consistent. Maintain stable, competitive terms that attract international participation. Each time COMEX raises barriers, China lowers them relatively. Each time Western paper markets become more expensive, Eastern physical markets become more attractive. The BRICS gold settlement mechanism, scheduled for pilot testing in Q2, will reference Shanghai prices, not COMEX prices. The mechanism being built to bypass Western financial infrastructure incorporates exchanges that don't panic hike margins when delivery stress develops. This is what a system looks like when it runs out of time. The CME margin hike is not confident policy from a stable institution. It's desperate policy from an exchange watching delivery demand approach levels its settlement system cannot handle. The trap has no exit for the shorts who built positions assuming paper gold markets would always function. Those shorts now face margin calls on positions that lose money if gold rises, and gold rises when shorts cover, which is what the margin hike forces them to do. The covering creates buying pressure. Buying pressure raises prices. Higher prices increase losses on remaining shorts. Increased losses trigger more covering. The feedback loop accelerates. The exchange raised margins hoping to reduce open interest on both sides, giving delivery infrastructure breathing room. But the reduction isn't symmetric. Longs who want metal hold. Shorts who fear margin calls cover. The net effect is buying pressure, not selling pressure. The margin hike that was supposed to calm the market instead tightens the squeeze. The tool designed to manage volatility creates the volatility it was meant to prevent. The intervention produces the opposite of its intended effect. This is characteristic of markets in terminal stress. Every intervention backfires. Every tool deployed creates new problems. The system's operators lose control of outcomes they once managed easily. The crash incoming narrative requires believing that margin hikes cause crashes. The evidence shows margin hikes during bull markets accompany continued bull markets. The evidence shows banks are covering shorts, not adding them. The evidence shows physical premiums are widening, not narrowing. Every data point contradicts the narrative. The narrative persists because it serves the interests of those who are short, who need you to sell so they can cover at lower prices. The truth is simpler. The exchange is scared. The banks are fleeing. The delivery system is failing. The margin hike is desperation, not confidence. Those who understand this distinction position accordingly. They recognize that margin hikes in delivery-stressed markets are bullish, not bearish. They recognize that paper gold dysfunction supports physical gold value. They recognize that institutional behavior, fleeing shorts, widening premiums, Eastern accumulation, tells the true story while Western narratives obscure it. The question is not whether a crash is coming. The question is whether you believe the narrative or the data. The narrative says crash. The data says squeeze. The narrative comes from institutions that benefit if you sell. The data comes from markets that don't lie about their composition. The margin hike is real. The interpretation is choice. The institutions have made their choice. They're covering, not adding. Their choice tells you what they actually believe, regardless of what headlines say. Reality asserts itself through price action that eventually reveals who was right. The margin hike takes effect February 3rd. The delivery window extends through February. The squeeze, if it develops, unfolds over days and weeks, not hours. The crash narrative will persist because it serves powerful interests. The data will persist because data doesn't have interests. It simply measures what's happening. What's happening is a market where delivery demand exceeds supply, where shorts are covering desperately, where physical premiums widen daily, where the exchange is raising barriers because they fear what happens when barriers fail. None of this suggests crash. All of this suggests the opposite. A market coiling tighter, building pressure, approaching a release that margin hikes delay but cannot prevent. The truth about the margin hike is that it's not a crash signal. It's a surrender signal. The exchange is admitting it cannot manage the delivery stress through normal operations. It's using the one tool it has, making paper gold more expensive, because it has no tool for making physical gold more available. The admission is valuable information. It tells you where the stress is concentrated. It tells you which positions are vulnerable. It tells you what the institutions fear. They fear a squeeze. They fear delivery failure. They fear unlimited losses on concentrated short positions. They don't fear a crash. A crash would solve their problems. A crash would let shorts cover at lower prices. A crash would relieve delivery pressure as longs sell positions. The margin hike is designed to prevent what would help shorts and create what would hurt them. The hike is bearish for shorts and neutral to bullish for longs. The hike is the opposite of what the narrative claims. The truth is available to anyone willing to examine the data. The truth contradicts what you'll read in financial media. The truth reveals that gold crash incoming is wish fulfillment for trapped shorts, not analysis of market structure. Believe the data. Believe the behavior. Believe the premiums. The margin hike happened. The truth about what it means is the opposite of what they're telling you. The squeeze isn't canceled. The squeeze is confirmed by the desperation of those who see it coming and cannot escape.